WorldCom stock lost 99.9% of its value in just 3 years, as a $150 billion telecom giant collapsed into a company worth less than $150 million. That collapse wasn't just a stock chart. It erased pensions overnight, cost 17,000 people their jobs, and became the biggest bankruptcy the United States had ever seen. By the end of this video, you'll see exactly how a small long-distance reseller borrowed and bought its way to the top of corporate America, and then hid billions of dollars to stay there. The story starts in a coffee shop. In 1983, after working as a milkman, a bouncer, and a basketball coach, Bernie Ebbers helped raise $650,000 on the back of a business plan literally sketched on a napkin. That company, Long Distance Discount Services, undercut AT&T's rates using discounted bulk phone lines, and Ebbers took over as CEO just 2 years later, in 1985. Over the next 2 decades, Ebbers grew the company almost entirely by buying rivals with borrowed money. By 1995, after swallowing more than 60 smaller companies, the business had renamed itself WorldCom. Then came the big swings: $12 billion for MFS and UUNet in 1996, $37 billion for MCI in 1998, and finally a bid to buy Sprint for $115 billion, blocked by regulators in 2000. Regulators in Washington and Brussels both concluded the deal would leave too few competitors in the long-distance market. The MCI purchase alone was the largest corporate merger in American history at the time, and it turned Bernie Ebbers, the former motel operator, into one of Wall Street's most celebrated CEOs. The combined company became the second-largest long-distance phone carrier in the United States, trailing only AT&T, and by 2001 WorldCom ranked 42nd on the Fortune 500. Investors couldn't get enough of the stock. $100 put into WorldCom shares in 1989 was worth $1,580 by January of 1996, a return that made the stock a Wall Street favorite, drew in even more capital, and funded still bigger acquisitions to come. Mutual funds and everyday retail investors alike piled in, drawn by a decade of returns most of Wall Street couldn't match. By the middle of 1999, WorldCom shares hit $64.50, and the company's total market value climbed to roughly $150 billion, bigger than most countries' entire economies. Ebbers' own stake made him a billionaire, with a personal fortune that peaked near $1.4 billion that same year. It didn't last. Regulators killed the Sprint deal in 2000, the dot-com and telecom bubble burst, and WorldCom's entire growth strategy, by the next company to keep revenue climbing, suddenly had nowhere left to go. By mid-2001, the company was already warning Wall Street publicly that its once explosive growth was slowing sharply, a warning investors mostly shrugged off, trusting a decade of nearly uninterrupted earnings beats. But Ebbers had borrowed heavily against his own WorldCom stock to fund side ventures like ranches and timberland. When the shares started falling, the board handed him $408.2 million in company loans between 2000 and 2002, just to stop him from being forced to sell, giving the CEO every personal reason to keep the stock price looking healthy. Prosecutors later pointed to those loans as evidence of just how personally entangled Ebbers had become with his own company's stock price. With no more acquisitions to fuel earnings, WorldCom's chief financial officer, Scott Sullivan, started moving over $3 billion of ordinary network operating costs, the fees WorldCom paid other carriers to complete calls, onto the balance sheet in 2001, relabeling everyday expenses as long-term capital investments so they could be spread out over years instead of subtracted from profit right away. Because the entries were spread across thousands of accounts company-wide, the fraud was almost invisible to outside auditors looking at the numbers in isolation. Here's the trick in one chart: WorldCom had $14.7 billion in real network costs in 2001. Of that, about $3 billion was quietly reclassified as capital spending, and another $800 million was hidden the same way in just the first quarter of 2002. In accounting terms, that's called capitalizing an expense, normally reserved for things like new equipment, not the routine cost of running a phone network. Because capital spending gets depreciated slowly over many years, moving costs there instead of expensing them immediately made quarterly profits look far healthier than they actually were. In May 2002, WorldCom's Vice President of Internal Audit, Cynthia Cooper, and a small team started quietly digging into those capital accounts, working nights, in secret, without telling the CFO. Within weeks they'd found billions of dollars that didn't belong there. Cooper's team reported directly to the board's audit committee rather than company management, bypassing the very executives who had built the scheme. Time magazine later named Cooper one of its persons of the year. The stock had already crumbled to about $2 a share by June 2002. Then, on June 25,
WorldCom admitted the fraud publicly, and by the next day shares were trading below $1, down from that $64.50 peak just 3 years earlier. Shareholders who had held on through the dot-com crash, hoping WorldCom would recover, now had almost nothing left.
WorldCom first admitted to $3.8 billion in fraud. But as investigators kept digging through the rest of 2002, that number kept growing, first to $9 billion, then to a final tally of more than $11 billion in overstated assets, the largest accounting fraud in American history at the time. Each new revision made headlines of its own, and each one further destroyed what little trust remained in WorldCom's books. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy, listing $107 billion in assets against $41 billion in debt, by far the biggest corporate bankruptcy filing the United States had ever seen. At the time, WorldCom still employed roughly 85,000 people worldwide. It remains, even decades later, one of the defining moments in the history of American corporate accountability. Enron's collapse the year before had already shocked the country, with $63 billion in assets. WorldCom's bankruptcy was nearly double that size, instantly making it the largest bankruptcy in American history. Its shares were delisted from the Nasdaq entirely and, by the end of the year, worth essentially nothing. For creditors and remaining shareholders, the bankruptcy proceedings that followed would drag on for years. It wasn't just outside investors who got hit. At the end of 2000, WorldCom employees had $642.3 million of their retirement savings sitting in company stock, nearly a third of the entire retirement plan. After the collapse, that stake was worth just $18.7 million, well under 4% of the plan, a wipeout of ordinary workers' savings, not just Wall Street's. For many employees nearing retirement, there was no time left to rebuild what had been lost. Exactly 21 years ago today, on July 13, 2005, a federal judge sentenced Bernie Ebbers, the former basketball coach who built and broke this company, to 25 years in federal prison. He'd been convicted a few months earlier, in March 2005, on charges of fraud, conspiracy, and filing false financial statements. He would ultimately serve less than half that sentence, released in 2019 due to declining health, and died the following year. Congress responded fast. The Sarbanes-Oxley Act, which required CEOs and CFOs to personally certify their company's books under penalty of prison time, became federal law less than 2 weeks after WorldCom's bankruptcy filing. WorldCom itself didn't disappear, it emerged from bankruptcy, dropped the name that had become toxic, and was sold to Verizon in 2006 for roughly $7.5 billion, a fraction of what it had once been worth. And WorldCom's own title, America's biggest ever bankruptcy, lasted exactly 6 years, until a bank called Lehman Brothers filed an even bigger one in September 2008. Every record eventually falls. The only real question left is whose turn is next.